Hello and welcome to our Academy Accounts Workshop Part 2. I'm Hugh Swainson. I'm a partner within Buzzacott's charity and not-for-profit team. And with me today, I've got Catherine Biscoe and Jamal Mir, also from the same team, who are going to take you through the session today. In part 1 of our Academy Accounts Workshop, you'd have heard about the Academy Accounts Direction and specifically the Coketown model accounts, and we'll talk you through the technicalities of that set of accounts. Today we've got more of a practical workshop looking at the year-end accounts preparation and the audit process. So the agenda today, I'm going to talk you through the accounts preparation process, specifically all the information that you need to gather and coordinate in order to pull together a set of accounts. Then Jamal's going to look through the practicalities of putting together that set of accounts, so taking your trial balance and turning that into a set of Academy financial statements. And finally, Catherine's going to talk through the audit requirements and some of the key things you need to think about in preparing for the audit. We've got a bit of time for questions at the end, hopefully, as well. So just a bit of virtual housekeeping to kick off with. As this is a webinar, you're automatically muted and your webcams are off. So, but you can ask questions anytime throughout the session by using the Q&A panel on the right-hand side of your screens. And as I say, we'll address as many questions as we can if we've got time at the end of the session, but any that we don't get around to, we'll cover via written follow-up. So please do ask questions as we go. To protect your privacy, all of these will be answered anonymously, and the session's being recorded, so we'll circulate the recording along with the slide deck after the event. So now let's kick off with the first part of the session on the accounts preparation. So over to my first slide. There's obviously a lot of information that is contained in a set of Academy accounts. You'll have seen that in part 1 of the workshops. There's a lot you've got to coordinate and bring together. So I first want to just look at what is it we need to sort of plan out and bring together as part of a year-end set of financial statements. The first few bits are very obvious. You need to get all of the transactions onto your accounting system, make sure everything's posted, all those accruals are in, everything else. And then you've got to go through your year-end reconciliation process to get a fully reconciled trial balance. Once that's done, it's a case of mapping that trial balance into a set of accounts, and Jamal's going to look at that process of how to take that and look at an Excel workbook of how to analyse out that financial information into a set of accounts. Not all of the information in your statutory financial statements will come straight from the trial balance. There's a number of items of information and schedules that you need to prepare, both for the accounts and for the audit. So we'll have a look through some of those areas that you need to prepare in addition to having a fully reconciled trial balance. And the other thing to think about is the words section of the accounts, so the trustees report and the governance statement and preparing that. Some of that's financial, but there's other bit where you may need input from other people, such as the achievements and performance, or maybe from the clerk to the governors around things like people's attendance at board meetings, that kind of thing. So a bit to coordinate there. The timing is also worth thinking about. Whilst a lot of this stuff have to wait for the year end and everything to be posted and reconciled, there's a fair bit of it that can be started, like the narrative bits of the accounts, a bit earlier on. So the timing's worth sort of planning through. Just a note on the revised ethical standard 2019. So you may be familiar, this is a standard that applies to auditors, and it was the one that resulted in internal audit and external audit needed to be done by separate suppliers. In terms of accounts preparation, it does refer to this as well. And the importance here is that we carry these out where we're supporting Academy Trusts with accounts preparation via separate teams of people. And really this revised ethical standard highlights the importance that, you know, these ultimately are the Academy Trust accounts. So it's important before the accounts get handed over to the audit team that you're comfortable with the numbers within that and have ownership of them before they go for audit. So over to the next slide. In terms of the year-end preparation, really this slide here just to highlight there's a lot of reconciliations and information that you have to coordinate. Obviously, some of that is things that you'll be doing throughout the year, such as your monthly bank reconciliations, VAT, other things like that. Other things will be probably just done once a year for the accounts preparation, such as the local government pension scheme journal to calculate, to post the liability for the local government pension scheme, and things like the remuneration disclosures around higher paid staff and staff numbers, that kind of thing. So whilst some of this is sort of a normal month-end process, there's quite a bit of extra stuff needed for the year end. So it's important to sort of factor in that into your timing of your year end closure as well. Particularly if you're in part of a multi-academy trust, obviously you need to coordinate all this information from multiple schools and make sure it's in a consistent format and consistently presented as well. And over to the next slide. What I wanted to highlight was what are the key issues that we see to really watch out for in preparing for the year end? What do we see some the most common ones coming up as part of the accounts preparation and audit process? And we've highlighted a few of those here. The first one is on the fixed assets. I think this is an important one because often the focus in year through the month end in the management accounts is often on the revenue fund balances or just the cash sort of accounting for the capital fund, and a lot of academy trusts don't sort of capture those depreciation journals and things throughout the monthly management account. So it's important that all of that is up to date for the year end. So you've got a full fixed asset register. Often academies have their fixed asset register in Excel, but whatever format you've got it in, that's all complete and reconciled for the year end, and that everything on that register is up to date. So things like if making sure that all of the assets on there are still in use, that any disposals are captured on the register, and it's fully up to date for the year end. So a lot of work tends to go on over the summer for academy trusts. So the principle is that any work carried out right to the 31st of August needs to be captured in your figures. So even if it's not been invoiced yet, making sure that's accrued into the year-end balances for any work that's been carried out up to 31st of August. So getting the cut-off right is important. Another key issue is whether items of spend are capital or revenue in nature. There's some things that are very clear cut. If you've got a new building structure, it's capital. If you've got something that's just repairs, it's revenue in nature, you expend it in the year. But there can be a lot of stuff that's a bit of a grey area with academy trusts. So it's about being consistent and having policies on what you capitalise and what you don't capitalise. And there's been a shift in recent years towards sort of more component accounting. So things like sort of windows or roofs, to start sort of capitalising those sort of things and considering whether they've got the same depreciation period as the overall building. But the important thing is that that's all decided up front before the year end, and the decisions around capital or revenue is agreed on early on in the process. Fund accounting is probably the most important area in preparing academy accounts. So I've got a whole separate slide on that, which I'll come on to. The pension journal, so the local government pension scheme liability is captured on the balance sheet. That can be a big number in academy trust account, and there's lots of disclosures going along with that. But ultimately, it's just one journal that gets posted to the financial statements. You'll see in the packs that were circulated in advance of this session that there's a worked example of the pension journal. It's a few years old, but still works. So if you are interested in how to post that journal, please do look at that worked example that will take you through it. And just a reminder of opening balances, easily forgot about. Do make sure that the balances that were signed off in last year's financial statements agree to the opening balances that you've brought forward on this year's accounting system, because obviously that's the starting point for preparing the accounts. That's got to be reconciled up front. So those are some of the key issues. On the next slide, I've gone into the fund accounting in more detail. So here you can see the funds note within the Coketown model accounts. And just to explain this, the columns in this note just take you from the brought forward funds to the carried forward funds after taking account of the income and expenditure in the year. And the rows detail each of the various pots of money, and it's split between the restricted general fund, which is all your government money for and other sources for the in-year activity, so the GAG money. You've got your restricted fixed asset fund, which is all your capital money coming in and your capitalisation of those assets. And then you've got your unrestricted funds, which is things like lettings that aren't restricted to any particular purpose. And if we just go through this note, the first column is very straightforward because that agrees to your last year's signed accounts, and the income column is also tends to be relatively straightforward because the nominal ledger normally sort of analyses things like GAG and other sources of income within it, so you can easily allocate them to this note. The challenge is when we get to the expenditure column. Academy trusts won't tend to account on their ledgers as to which pot of money costs come out of. So if you have a staff member, they're not specifically a GAG staff member or a pupil premium or an unrestricted, they'll just be within staff costs. So at the year end, we need to figure out how to allocate the expenditure between funds. The way to do it is almost by a process of elimination. So the first thing to look at is those restricted pots of money that you need to track. So things like pupil premium, you might have catch-up funding this year that might be either fully spent or not fully spent. It's making sure that those are fully reconciled for the year end and you're clear on what money you've spent out of those pots of money and whether any is being carried forward. So it's important for when the accounts preparations happen, you're clear on what balances you're carrying forward on any of those restricted pots of money. Another area to look at is the unrestricted funds. So as I say, the income for the unrestricted funds is easily identifiable. There may be direct costs of some of that income. So for example, things like lettings, you may have a specific person who does the lettings or a direct cost of those lettings. And sometimes it's not appropriate then to allocate those costs to the GAG money or anything like that. So you should just do a sense check that you're capturing the costs of the unrestricted funds in the unrestricted row where applicable there. And as a result of that, once you've gone through that process, the number, the 4175 that you can see as expenditure on GAG here, should ultimately fall out of the process. So whilst that's not a number that sits within the accounting system, if you're a Coketown Academy Trust, that 4175 would be able to arrive at that through this process. So that's how you allocate the expenditure in this section. The other key thing to highlight is the capital fund. The capital fund's income's fairly straightforward again, and the expenditure tends to be the depreciation charges going through. Just to note, not all capital income is necessarily spent on capital. So sometimes you have things like devolved formula capital, which might be spent on repairs and things like that. So if that's the case and you recognise the income in the capital fund, you may need to transfer some of that back to the revenue fund if the costs have gone through as revenue costs. The other key thing here is any fixed asset additions that you have in here, you need to know where those are funded from. So it's important to do a reconciliation of looking at all the fixed asset additions you had during the year and where they were funded from. So if they're funded by a source other than out of those sources of capital income, you'll need to do a transfer between funds. So you can see in this case, Coketown had £10,000 worth of fixed assets that were funded from GAG money, and so they had to do a transfer across from GAG to the restricted fixed asset fund. But the way to come up with those numbers is to understand where each of the fixed asset additions in the year were funded from. What that leaves you at the end with is this 10,125, which is the total of the fixed asset fund, and that sometimes equals the value of tangible fixed assets on your balance sheet. But it's important to reconcile and see whether that equals the value of fixed assets or whether there's any unspent cash in the capital fund. So if there's, say, SIF money that you've got that you've not spent yet, it's important that that money's ring-fenced in the fixed asset fund. So you don't want to mix up your capital money with with your revenue money, because you might then misreport how much revenue funds you've got available to spend. So any capital money that's not spent needs to sit within the capital fund and be separately and be identified within there, so that you're clear what the difference between the net book value of fixed assets and the value of your fixed asset fund is. Final thing just to note on this is that there's different rows to this fixed asset fund, and this is all about the source of funding. And the only way to really do this is that each time you purchase a fixed asset on your fixed asset register is to note the source of funding when you purchase those assets. So therefore, you can just filter by the source of funding on your fixed asset register, and you can see that these assets were funded out of the capital expenditure from GAG, and therefore this depreciation, 3,000 in this case, should be allocated against that row in this note. So that's the way that you can then split the depreciation across those various fixed asset funds. So that's the funds note in the accounts. Just on the next slide, to note that if you're a multi-academy trust, there's a disclosure of the funds by school, unless you've got a formally reserved pooled reserves policy. So in this note, you can see that the revenue funds are split out by the 3 schools within Coketown Academy Trust. To note that the fixed asset funds and the pension reserves are separated off at the bottom. So you would expect that these numbers for the 3 academies here and the central services actually match up really with what's in the management accounts, subject to any year-end journals. These aren't numbers that easily come off the trial balance and are easy to map, so it is important to sense check them back against what you've got in your management accounts and see if these balances tie into what you've been reporting throughout the year. On the next slide, just to highlight, there's lots of disclosures within the financial statements, or potential disclosures, that you might have to prepare information for. We have lists of information that we send out in advance of audits, which you can sort of tick through, but just as I said, not all of the information will come from the trial balance. So you have to go through and consider whether you've got any capital commitments or operating lease commitments that you need to capture in the financial statements, and make sure that you prepared information on that if you need to. The biggest area of this over on the next slide is on the staff cost disclosures. There's a whole range of disclosures for the financial statements all around staffing, and also for the AAR. So things like higher paid employees disclosures, staff numbers, key management personnel, all these things you'll need to compile the information from the payroll records and produce schedules for the year end, which can take a bit of coordinating, especially when you combine it with the AAR, which we've got on the next slide, where there's a whole series of additional disclosures required around the staff. And the for the AAR on the next slide, the staffing disclosures and everything, we don't have the guidance out yet. It probably won't be released till later in the year, but we're not expecting any big changes. So you may wish to prepare all of these disclosures on the same basis as last year whilst you're doing the year-end preparation as well. As I say, the biggest areas around those staffing disclosures, things like full-time equivalent, split between permanent and temporary, that kind of thing. But other things to highlight, there's benchmarking information within the AAR, particularly for the multi-academy trusts, where they sort of benchmark by school. That's becoming increasingly important. So the ESFA has got an online benchmarking tool that people are making increasing use of, which is driven by the data in the AARs, and that data is only really as good as what's coming off your ledgers and how that's input into the ledgers. So I would encourage you to take an interest in that benchmarking return in the AAR this year, and making sure that you're keeping the quality of that data as high as possible going in there, because it is a very useful benchmarking tool when the data going into it is of good quality. So those are the key things to highlight about pulling together the information for preparing the accounts. I'm now going to hand over to Jamal just to talk you through that practical process of accounts preparation.
Thanks, Hugh. Good morning, everyone. So I'm going to spend a bit of time talking through our Excel Academy Accounts template. This is the tool that we offer to our Academy Trust clients to help take your closing trial balance and convert it into a set of statutory financial statements compliant with the ESFA Accounts Direction Disclosure requirements. It may be that you'll be asking Buzzacott to help with the preparation of your statutory accounts, but we hope that this part of the session will still be useful for you, as we hope it will help you to understand the process by which your accounts will be prepared. We'll always ask you to review the numbers after we've prepared them, and hopefully this session will provide you better context of how we would typically complete the work. So on my first slide, I've set out some of the key benefits of using our template. And there's actually quite a few different templates that we have available, including ones that could be used by single academy trusts, ones for multi-academy trusts, and also those for subsidiaries as well, where group consolidation is required. And there's principally two key reasons for using these templates. Firstly, the Excel workbook helps provide an audit trail between your trial balance and your final accounts. It's typical for most of our Academy trusts that we work with for the numbers to ultimately end up on a Microsoft Word document, which contains both the narrative reports, including the trustees report and the governance statements, as well as the numbers. But actually, if you were to look at that Microsoft Word document in isolation, it can become tricky to understand the makeup of the numbers and how some of those balances have been derived. As you'll hopefully see as we work our way through this session, this workbook will allow you to trace the majority of the numbers back to your source trial balance. Secondly, it will help you produce a compliant set of accounts that meet the ESFA's disclosure requirements. We update all of our Excel templates every year to take account of the latest iteration of the ESFA accounts direction and any new disclosure requirements. So using these templates should offer you a good level of confidence that the disclosure requirements have been considered in full. And actually, even if you've decided not to use our templates or have your own pro forma for compiling the statutory accounts, you may still find it beneficial to refer to our template to see how we have approached some of the workings behind some of the ESFA disclosures. There are some other benefits to using our templates as well. There's built-in validation and integrity checks throughout the workbooks, which will help to alert you of potential errors in data entry or where numbers which should match in different parts of the accounts are not matching. We'll show you how these validation checks appear on a later slide. There may also be a need for adjustments to be made to the figures after the accounts preparation work has begun or after the audit has begun. These can be incorporated by feeding through the relevant journal adjustments from a worksheet within the Excel workbook containing a log of all such adjustments. This again will help keep a clear trail of how the numbers have been derived. And again, we'll see how this works on a later slide. Finally, it also provides a simple way of aggregating the individual trial balances for multiple schools if you're a multi-academy trust. So moving on to my next slide, we can begin by seeing what the workbook actually looks like. So on the right-hand side of the slide in front of you, you will see the SOFA tab, which pretty much looks like the SOFA tab you will see within the Coketown model accounts. The key difference being that our template has particular cells shaded in different colours. And these colours are quite important. The same cell colouring arrangement is used throughout our workbooks. And to the left of the slide, we've provided you with a key explaining what each of those colours represents. So the green coloured cells are user field cells, which means that the relevant figures will need to be hard typed by the user directly. What you'll hopefully observe as you use the workbook is that we've tried to minimise the use of green cells as far as possible. The whole purpose of the workbook is to allow you to easily track numbers back to your source trial balance, so it makes sense to limit the number of hard type figures. The green cells are mainly used in areas such as staff cost disclosures, where the analysis may not be available from your trial balance, or for example, comparative information where the audit trail already exists in the form of last year's signed accounts, so there's no need to remap last year's trial balance again. On the other extreme, the blue coloured cells are those which contain a pre-filled formula, which will try and grab data from another location within the workbook, ultimately flowing the link all the way back to your trial balance. There is a middle category, the purple coloured cells. These require the preparer to give a bit more thought as to the best way of pulling the data into that cell, but ideally linking back by formula wherever possible. This is typically going to be relevant in relation to fund accounting decisions. As an example, you may have a nominal account on your trial balance, which is used to record your general donations income, but some of that income may be restricted and some unrestricted. By default, the template will assume that all of your general donations are unrestricted, but if that's not appropriate, you may need to adjust the formula in a neighboring purple cell to show the correct analysis. So how is it that the numbers are populated, and where do the figures in the blue cells come from? So if we move on to the next slide, we'll see the main tab within the workbook, which will drive where the numbers are spat out into the relevant areas of the accounts, the trial balance tab. So the screenshot on the right-hand side of the slide in front of you shows an extract of a trial balance tab that has been partially completed. The green cells are where you would enter your raw trial balance, i.e. columns C, D, and E. And this can be literally copied and pasted from an Excel export of the trial balance taken from your accounting system. The key role for the preparer is to complete column B, the type column. This will determine where the number feeds through to within the rest of the workbook. For the template to work, you can only use a type that is available from a predetermined listing. There is a tab within the template workbook called Key for TB Codes, which contains a full list of the available types, and an extract of that tab is shown on the bottom left of the slide in front of you. So taking prepayments as an example, you would check the Key for TB Codes tab to find the most relevant type, which in this instance is the letters PRE or pre. And if you've successfully entered a type which is included in our predetermined listing, column A of the trial balance tab will automatically update to say yes, the type that you've entered is valid. But if you've entered in the type incorrectly, or you've made up your own letters, column A will indicate that the type is not valid. If your accounts are not balancing, then one of the first checks that you probably should do is filter the column A for any no responses to check that whether there's been a typo in entering any of the data in this column. You may at this stage also be thinking, hang on, why is column B coloured blue and not green? Well, for those of you who have used our templates in previous years and do not wish to have to go through the effort of reassigning the type for every single nominal account again, there is a facility within the workbook to help automatically populate this column by copying and pasting last year's mapped trial balance from the prior year TB tab or the PYTB tab. There's full instructions for everything that I'm going through, including the prior year TB point that I've just mentioned, within a guidance tab on our workbooks. So I won't go into much more detail on that at this point. But continuing with our example of prepayments, if you take a mental note of the balance of prepayments on this trial balance is a £39,000 debit balance, we'll now move on to the next slide and see how this data, how this gets pulled through into the accounts itself. So on the bottom of this slide, you'll see an extract of the debtors disclosure note, and you should see that at cell J71 of this disclosure, the prepayments and accrued income line has correctly returned £39,000 as the prepayments balance. And if you take a look at the Excel formula bar on the same screenshot for cell J71, you'll hopefully see how the type mapping is now being used by the formula to return the correct value. The Excel formula is this Excel formula is used throughout our template and is simply asking Excel to add up all the figures on the trial balance with the relevant type name used at the end of the formula. For the preparer's convenience, at column R, we've also noted the type that is being searched for within the formula in the particular blue cell in that row to save you having to look through each individual cell's formula if you're trying to troubleshoot. So on the next slide, I mentioned earlier that there may be a need to make further adjustments to the numbers after the work on the accounts preparation or the audit has begun. Any such adjustments should either be recorded in the Accounts Journal tab or the Audit Journals tab, depending on whether the journal was identified during the accounts preparation phase or during the audit phase. So say, for example, we determined during the audit that the purchase of some new furniture for the Academy Trust costing £5,000 had been incorrectly added to the prepayments balance. You can see on the top right screenshot the details of the necessary correcting journal which needs to be made. Now, so long as the nominal code is correctly entered within column C of the Journals tab, The formula included within the journals column on the trial balance tab, i.e. column F on the bottom right screenshot, this will automatically populate the necessary journal and adjust the final value to be used in the accounts. Whilst this process is automated to a large degree, please do be careful, as typos or transposition errors made in entering the nominal code on the journals tab could mean that the adjustment is made to the incorrect trial balance line or not adjusted for at all. On the next slide, we'll look at the fund's disclosure note again. As Hugh's previously highlighted, this is a crucial disclosure note within the accounts. Unfortunately, this workbook or any other workbook or software will not be able to miraculously produce a set of accounts 100% on an automated basis. And one of the key reasons for this is the fund accounting. It's very unlikely that the way your accounting software will export the results for the year into a trial balance will provide the full analysis needed to be able to easily map the movements on individual restricted and unrestricted funds during the year. So a more careful review of this disclosure will be needed by the preparer. Our template is set up to make certain presumptions regarding the fund movements, but those presumptions may not be accurate or appropriate for your circumstances. To be fair, the first two columns should be pretty straightforward. The balance brought forward is a green cell and will be hard typed based on the number included in last year's accounts. And the income should generally be mapped out okay, depending on how detailed your chart of accounts is. As Hugh mentioned in the previous session, it's really the expenditure column which needs a bit more attention. As an example, the template is set up to make the assumption that the pupil premium income or other grant income will have been fully expended in the year of receipt, and this may not be appropriate for your Academy Trust, in which case the formula in column J may need to be amended. Similarly, there are typically various rows within the restricted fixed asset fund section of the disclosure, depending on how your fixed assets have been financed. But the trial balance will likely only show the total depreciation cost for the year by the class of fixed asset rather than by the funding source. You will therefore need to determine the best way of allocating the depreciation charge for the year between rows 18 to 21 of this disclosure note. Similarly, on the next slide, for multi-academy trusts, there is a requirement to disclose the revenue reserves by individual schools. Again, the template will try and calculate this based on figures within the individual school trial balances. But as Hugh says, it would be important for you to check those against your own expectations and internal management reports and adjust the formulas as needed. So on my final slide, just a few additional pointers. Firstly, as I say, there is a guidance notes tab included in our workbooks. Please do read through these before starting the work, as it will provide a refresher on the steps needed to compile your accounts. It may be after that you've completed the steps, you find that your accounts do not balance. If this looks to be just a rounding difference, our recommendation will be to check the final numbers column on the trial balance tab. The workbook is designed to round off your trial balance figures to either pounds or thousands of pounds. If your trial balance is not netting down to exactly zero, this rounding difference has probably risen because of this rounding process. In this case, just adjust one of the largest figures on the final column by adding or minusing 1 or 2 to clear the rounding difference. But it may be that the imbalance is not because of rounding, but because of the fact that some of the TB codes haven't been pulled through to the right place in the accounts. There are 3 things that you should do to try and zero in on the cause of this imbalance. Firstly, as I mentioned earlier, please do double check whether the first column on the trial balance tab does return a yes in the valid column, and do check that the types that you've used are the ones contained within our predetermined list. Secondly, on the right-hand side of the trial balance tab, you'll also see another set of filtered columns that show exactly which disclosure notes the figures will have been taken to. You can use these filters to help locate any potential errors. And finally, you'll notice throughout the accounts template, there are various validation boxes to the right-hand side of the actual accounts pro forma. You can see an example of this on the screenshot to the right-hand side of the slide in front of you. These boxes should light up to alert you if there is an issue with the data pulled through on a particular row. So again, addressing these items first should help you to identify the cause of the imbalance more efficiently. Please do make changes to the templates to meet your own disclosure needs. We've modeled these accounts templates on the Coketown accounts, but we do know that some of our academies like to include additional analysis over and above what's included in Coketown. But where you do this, please do try and keep to the same sort of formulas and principles as for the rest of the template. The more you start adding in hard typed figures, the more difficult it becomes to see that audit trail. Finally, there is an accounts return tab included within the template. For the avoidance of doubt, this template is not going to populate the entire accounts return for you, but the tab is there to capture some of the additional information which we will need at a later stage in the audit process. And if this is completed at the same time as the accounts preparation, then we will have a lot more of the information ready for when we need it at that later stage. And I think that's everything from me on the Excel workbook. So I'll now hand over to Catherine, who will discuss some of the audit preparation requirements.
Thank you, Jamal. So yes, in my section, I'm going to cover the various audit requirements that you have as an Academy Trust and help you prepare for the year-end audit. So if we can turn now to my first slide. The first thing I've done here is just set out the various audit requirements that you have as an Academy Trust. So there's the financial statements audit, the regularity audit, and the assurance on the AAR. So looking at the financial statements audit first, we need to propose an audit opinion, and this opinion states whether the accounts present a true and fair view of the results of the Academy Trust in the year, so in terms of its financial position during the year, and also, financial performance during the year and its financial position at the year end. They also look at whether they have been prepared in accordance with UK GAAP. So this means the latest financial reporting standards. In this case, it would be FRS 102 and the Charity SORP and relevant legislation. Again, in this case, the Companies Act. It's of course also looking at compliance with the ESFA's accounts direction and the Coketown model accounts. And this was covered in detail in part 1 of this webinar last week. And then also finally, whether the information included in the trustees report is consistent with the financial statements and also consistent with the auditor's understanding of the activities of the trust. So those narrative reports that Hugh was talking about in his first session are also within the scope of the financial statements audit. There is then a limited assurance conclusion on the statement of regularity, propriety and compliance that's made by the accounting officer, and also a limited assurance conclusion to the ESFA on the compilation and the contents of the Academy's accounts return. So on my next slide, I start by looking at the financial statements audit. So really, in order for the auditor to be able to reach an opinion on the truth and fairness of the figures in the accounts, they need to look at each of these in detail. The way that they will do this is by sort of documenting the work on an audit file, which is essentially a directory for each of the financial statements areas, as you can see here. So taking the example on the slide, which is the tangible fixed assets area, an auditor would need to get an understanding of where the numbers come from. So they would sort of need to agree through from the notes in the accounts through to the accounting system. But also maybe other underlying data. So in this case, for example, agreeing through to the fixed asset register too. You would need to look at sort of significant balances, so carrying out analytical work to understand reasons for variances against expectations, and there'll also likely be an element of sort of detailed vouching to supporting invoices or other documentation. And auditors will also be focusing on the risk areas in the first instance. So, for example, in this case, looking at fixed assets, if, for example, there was some capital work on the roof ongoing over the summer holidays, a key risk here would be around cut-off, really. So really, the auditor might be doing something like looking at invoices from the contractors received after the year end. And then they would go through this process for all of the various areas within the financial statements. So then moving on to my next slide, I've set out some of the practical information that you would need to pull together in advance of the audit fieldwork so that the auditors can go through this process. And this will hopefully ensure that the audit runs smoothly and that you're best placed to answer any questions that your auditors have. So that's things like schedules, which agree the accounts through to the TB. And of course, Jamal was talking about the Excel workbook that can facilitate this. You would have to look at year-end balance sheet reconciliations, balance sheet breakdowns for things like prepayments, accruals, aged debtors, aged creditors, schedules to support those additional disclosures that don't come from the trial balance, as Hugh was talking about. So things like your staff numbers, any severance pay in the year, the disclosures for the remuneration of higher paid employees and key management personnel, that sort of thing. And then, as well as the information which supports the figures in the accounts, auditors will also need to have access to minutes of board meetings, key committee meetings, declaration of interest forms, budgets, forecasts, and so on. So auditors would normally collate all of this in a prepared by client or PBC list, which they would share with you at the planning stage of the audit to help you prepare for the year end. So on my next slide, I have included just some extracts of the PBC list that we use for our academy clients. And then we have also shared the full version of this as a resource in advance of the webinar. So hopefully you can take a look at that later for your reference. But you will see from the extracts on this slide that, it should give you a good idea of the kind of supporting documentation that you would need to provide in advance of the audit. But I think as you will see as you go through, in most cases, it's probably what you're pulling together anyway, as part of sort of doing your year end and your year end accounts. So moving on to regularity now, on my next slide, I've just set out the sort of relevant definitions as a bit of a reminder. So regularity refers to funds having been spent on the purposes intended by Parliament. Propriety is all about standards of conduct, behaviour, corporate governance at the Academy Trust. And compliance refers to operating within the terms of your funding agreement, which we know obviously also includes compliance with the Academy's financial handbook in force at the time. On my next slide, I've included some of the most common issues arising from regularity audits across the sector, things like related party transactions that are not at cost, severance payments for which prior approval hasn't been sought from the ESFA, where a trust has entered into finance leases, or sort of actual instances of fraud or theft at the trust. And you may also have audit recommendations arising from your regularity audit where, for example, financial procedures are out of date or your procedures aren't in line with what actually happens in practice at the trust, or also where approval of relevant transactions aren't in line with the requirements of the Academy's financial handbook. Next slide, please. So for the upcoming regularity audits this year, it is the 2020 Academy's financial handbook, which is relevant. This was issued last June and it was effective for periods commencing 1st of September 2020. You will probably be aware that the new 2021 handbook was actually issued last month. It's also now referred to as the Academy's handbook rather than the Academy's financial handbook, as it increasingly has considered sort of wider aspects than just finance, so things like governance and so on. But it is the 2020 handbook that will be, what will be looked at as part of the upcoming regularity audits. So as we saw earlier, the requirement here is for compliance with the handbook. So it really is important that each year you ensure that you review any changes coming through from the handbook, the updated handbook, check that your financial and governance procedures and controls remain in line with this or whether any updates are required. And just as a reminder, some of the key changes which came into effect with the 2020 handbook were a number of clarifications around risk management, particularly the role of the board and the Audit and Risk Committee, now called Audit and Risk rather than Audit Committee, around risk management, looking at appropriate qualifications and ongoing professional development of the CFO role, making it a must requirement to have an appointed clerk, and as Hugh referred to earlier, removing the option for your external auditor to also carry out your internal assurance, and that change was required as a result of the Financial Reporting Council's revised ethical standard. So in your report and accounts, it is the accounting officer who signs off on the statement on regularity, propriety and compliance. And of course, if there are any reportable matters, these need to be disclosed and they need to be included with monetary amounts if known. As we saw earlier, the audit requirement in this regard is to provide limited assurance on this accounting officer's statement. So in order to do that, auditors will need to gain an understanding of your Academy Trust's controls and what checks are in place over those controls. We will need to review relevant transactions, also review supporting evidence. And at Buzzacott, we do this by using a regularity self-assessment checklist. So I've included some extracts of this on my next slide. And you should also have a copy of the full checklist in your pre-webinar resource pack. So really the rationale behind using the self-assessment checklist is that, as well as facilitating the audit work, it also serves as supporting evidence for the accounting officer's statement. Because in most cases, even though it is the accounting officer who will be signing off on regularity in the report, in most cases, they will be assisted in completing the checklist by the CFO, possibly the clerk, maybe others at the SLT at the trust. So as you can see on the slide there, the form includes various questions on each of the areas, and then there's space for the Academy Trust to include their response and also link through to any relevant supporting information. And this then forms the basis for the auditor's review and the detailed testing which follows. So just looking at the examples there for the remuneration of employees, there are questions around ensuring that pay is agreed at the appropriate rates, so therefore ensuring value for money, as well as what controls there might be over amendments to the payroll, things like what suggested supporting information you might want to upload as an Academy Trust, so things like your remuneration policy or agreed pay scales. And then we've also retained the section that was new last year on the checklist on what the Academy Trust is doing to reduce the risk of irregularity during the pandemic and sort of any periods of closure and therefore remote or hybrid working at the trust. So then on to my final regularity slide. The ESFA is due to issue an update bulletin on the impact of COVID on Academy Trusts, as they did last year, and we expect this in the next week or so. So from our attendance at ESFA Audit Forum meetings, we do expect that this bulletin will again include reference to regularity, as it did last year. However, our understanding is that the scope of the regularity audit will remain. So it will come down to the professional judgment of individual auditors as to whether the regularity audit work will need to be adapted or if any additional work is required. And this will really depend on the individual circumstances at each Academy Trust. So whether you adopted emergency protocols or updated schemes of delegation for operation during periods of lockdown, whether the governance of the trust, any key board and committee meetings continue to take place virtually, whether you were sort of adequately able to keep an audit trail of key decisions made and so on. Also, the DFE issued some guidance in February this year on how academies should continue to support suppliers during the pandemic, following the expiration of the policy procurement notes in October 2020. So again, as last year, we would expect the bulletin to sort of refer to a requirement to reflect this within the value for money review in your governance statement, and then sort of more widely also include reference to any circumstances where the pandemic may have adversely affected value for money for the trust. And then finally, fraud, and this is always a key part of the regularity audit process. Again, we've shared in advance a copy of our fraud questionnaire to be completed as part of the audit preparation, but I included it particularly on the COVID slide because unfortunately we have seen fraudsters taking advantage of changes in processes following moves to remote working. So I think there've been increases in things like invoice fraud where invoices are now being approved by email. So I think making sure that you continue to sort of thoroughly follow your processes and checks, so maybe checking invoices to purchase orders, checking supplier details on the invoice before payment, and so on. Similarly, if there's been an increase in use of credit cards, making sure that the controls over those are monitored effectively. And just more generally, you will be aware of the recent cyber security attacks on the wider education sector. So I think we would expect this to continue to be an area of risk and potential for increased assurance focus going forward. My next slide covers going concern. So the trustees should prepare the financial statements on a going concern basis unless the Academy Trust is winding up or has no alternative but to do so. And in order to reach that conclusion on going concern, they will need to review supporting evidence such as budgets, cash flow forecasts, and they need to look ahead a period of no less than 12 months from approving the account. So really, for the Academy Trust, it'll be, looking ahead to at least December 2022 for this year's accounts. And this conclusion and the basis for reaching it needs to be disclosed in the trustees' report and accounting policies of the trust's accounts. It could well be that in the current economic environment, making these assessments on going concern might be a bit more difficult if there might be sort of greater uncertainty underpinning some assumptions in financial forecasts. So it's probably well worth a look at the ESFA's Good Practice Guide Operating Academy Trust as a going concern, which was updated in May this year. The auditor responsibilities around going concern have changed following a revision to auditing standards in the year, and this will apply for Academy Trust's 31st August 21 year ends for the first time. So I have provided just a bit more detail on the new audit requirements on my next slide. So the auditing standard that deals with going concern was revised, as I said, and this was in response to recent enforcement cases, sort of corporate failures such as, Carillion, Patisserie Valerie, and so on. What it now means is that auditors will provide a positive audit opinion in their report. So rather than previously it was worded along the lines of nothing has come to our attention during our work to suggest there's a problem with going concern, it's now a positive conclusion. We're in agreement with the trustees' assessment of going concern, and we also need to flag any material uncertainties if relevant. Of course, in order to provide this more positive opinion, we do have to carry out increased audit work in terms of challenging the trustees and management's assessment of going concern, looking at the adequacy of the supporting forecasts and the evidence, and really looking at things like management bias and risk of management bias in the assumptions. So key documents that you will need to pull together in advance for your auditor would be things like budgets and forecasts, including cash flow forecasts, which cover the going concern period. So things like the BFRO, the 3-year budget forecast return that you submit to the ESFA, and also a paper which sort of details the Academy Trust's assessment of going concern, ideally reviewed by finance or audit committee to really demonstrate that trustees have adequately considered this as well as management. And then finally, we'll be looking at the latest readily available management information prior to signing the accounts in December. And then my final slide follows on from this, really, just looking at the reserves that the trust holds. So as you know, each Academy Trust should set an appropriate reserves policy, which has to be disclosed in the report in the accounts. This could be a monetary amount, or it could be a range, really, depending on sort of what's most appropriate for your academy. And you would then need to work out what your level of free reserves is at the year end and compare that against the required level in your policy. So if actual reserves are below the policy, you would explain what the trust is doing in order to build these back. And if it's over the policy, then you might want to set out how the trust plans to spend these for the benefit of the pupils. So what this slide is doing is really just setting out the calculation for free reserves. So how do you arrive at that figure, which is based on the charity SORB guidance. And in the case of Academy Trusts, reserves are usually understood to be your unrestricted funds plus any ESFA funding carried forward. So you would exclude tangible fixed asset fund balances and the LGPS deficit. In your 2021 accounts, you may, in your reserve disclosures in the accounts, refer to the sort of ongoing impact that the pandemic, sort of periods of closure at schools has had on your reserves, potentially if they've been impacted. But of course, this is expected, and that is one of the reasons for holding reserves in the first place, having that cushion to sort of draw down on when needed. So that is everything I wanted to cover on the audit side of things, and I will hand back to Hugh to wrap up.
So thank you, Catherine, and thank you, Jamal. We've just got time for maybe one or two questions before we finish. And the first question we've got is around for Jamal around the Excel templates that he was sharing on screen there, and just whether those can be shared following the workshop.
So just to confirm, we've deliberately not shared those templates with you ahead of this session, and that's because, as Catherine mentioned, we're just waiting on the ESFA's supplementary COVID bulletin to be issued, which we're hoping is going to come out in the next week or so. Once we've got those, we're going to update our templates for any changes reflected within that guidance, and just do a final bit of road testing before we issue it out to our clients. So if it doesn't come with the slide deck, it will come shortly thereafter. Thanks.
And just one final question before we finish. There's a question about the AAR process and the query that the ESFA has started doing these automated AARs via the software providers, and whether that will affect the AAR process this year. So just to give you the context of that, if anyone's not familiar with it, the ESFA has been looking to try and automate the process for various returns, including the AARs, and this is all sort of linked into the model chart of accounts. So it's one of the carrots they've given for adopting the model set of chart of accounts for academies, so that they then can just run some of these reports as automated as possibly. The status at the moment is they're working with software providers, and it's early days basically is the message. So they're working with all the main software providers who work with academies. I think FMS may be the one that's furthest forward in it at the moment, and the idea is it's not going to populate the whole return, it will only populate parts of it. So and obviously with that pre-population, it doesn't necessarily 100% guarantee that it's all correct. It still needs cross-checking. Some of the issues that we're sort of looking to explore in this first round is really around audit trail with all of this, because one of the issues around sort of auto population is trying to figure out where the numbers from and how then we get an audit trail to make both yourselves and us as auditors happy that that those numbers have come from the right places, and we know it's all working. So I think at this stage really the message is early days with this. There may be some testing of this new process this year, but hopefully it's something that will provide benefits in future years once they've sort of embedded it in and got it working across the various software providers. I think that's all we've got time for today in terms of questions, but we can follow up anything else afterwards via written responses. So really that just leaves me to thank everyone for joining us today for this workshop, and have a good rest of your day. Thank you.